So yes, the schedule today is that we are going to look at the leverage and risk. We're going to look at the Fibonacci retracements. We're going to look at support and resistance, and then patterns. So we're going to look at flag patterns that are bullish and also flag patterns that are bearish. And then we're going to look at the triangles and the ones that are bullish and the ones that are bearish. So if we go to any instrument on eToro, we can go to, for example, the market. And if we want to buy a single one instrument here, so for example, a stock or a commodity or indice or whatever, we can press on, for example, on natural gas, or we can just go to the commodities. So we'll focus mostly on gold in this session. So if we press trade, then the good thing with eToro is that it gives a really good overview of what kind of leverage they are offering, what kind of position you're taking, and how big part of your equity you're technically using, you're trading. So when I started off trading, I think the first deposit I made was $1,000 or something like that, because I wanted to try what this system was and so on. And I was not used to using leverage, so I did the same mistake as most traders do, and that is that I used way too high leverage. So I started off in trading Forex for most of the time, and yes, I tried X50 and I tried X100, and of course, really exciting to use that amount of leverage, because you can make a lot of money within a few minutes, but you can also lose a heck of a lot of money in a few minutes. And the thing is that it is just not sustainable in the long run. And this system is not built for leverage this high. So I'm quite certain that the way that eToro earns most of its money is basically they know that people will use this kind of leverage, and that they at some point in the future it will go wrong for them. That's also why they are so heavily regulated when it comes to leverage, because there is there's where people lose money. So in essence, leverage is a way to multiply your equity. So if you use X1 and you invest $100, that basically means that you invest $100. So the risk of investing with X1 is significantly lower than investing with, for example, 100x. So if you instead choose X2 and you invest $100, that basically means that you're investing $200. So to double your equity. $500, $1,000, and so on and so on. So the thing is that if you have low equity, you can actually earn money by using higher leverage. The thing is that it's just not sustainable in this platform. If you have another platform where you can basically click on one button and you enter the market, and you click another button to leave the market, then yes, then it is possible to use that amount of leverage, because it is just about timing. And that is the problem with this platform, that you have to click too often. It takes too long in order to enter a market and to leave a market. So it just isn't sustainable, I found, to use this amount of leverage. Even X20, it's not sustainable in the long run. The maximum amount of leverage I use, it is 10, and that is very rarely. I use 1 to 5. That is basically what I use. So when it comes to stocks, I only use 1, because I also invest in stocks to hold them for a very long time. So in dividend stocks, I have on another platform, not this platform, but another platform where I basically invest in those companies. I have a portfolio on the YouTube channel where you can see what companies basically I am investing in, and usually that is very safe investments and also stocks that give dividends. But then I also use 2x and I also use 5x. So in commodities trading, I usually use 2x or I use 5x, mostly 5x. And the same goes for Forex and indices. I also mostly use 5x. The times that I use 10x is when I trade in Forex exchange. So it is beneficial there in order to, if you only use 1x in Forex, you have to have a lot of equity, and basically it's not worth it. So you have to use a little bit higher leverage in the foreign exchange market in order to get anything out of it. And therefore, I try to tell people, do not use these higher leverages. If you're trading on this platform, it just isn't sustainable in the long run. And the thing that usually happens is that you start trading and you probably have the first 5 trades, you earn quite a lot of money, and then you feel like you are complete control and you just up at your leverage and you add more and more and more. And at some point, you are going to put most of your equity into a trade with too much leverage, and then you are going to find out that that didn't work. So that is how roughly 90 to 95% of traders lose their money, is because they use too high leverage. So this is also a matter of risk. The higher leverage you take, the bigger the risk you technically take. But also the amount of equity that you choose to invest of your total equity is also a matter of risk. And eToro does a really good job of basically telling you what amount of equity you're basically investing. So at this moment, it says 10.01% of equity. And usually I only invest around 2 to 5% of my total equity for any given trade. It doesn't really matter what trade it is, if it's a good trade or a bad trade. I use the same amount of equity every single time. And that is just, the reason for that is basically just risk management. It is trying to make several trades in a week, but using the same amount of equity, the same amount of leverage, but focusing on trades which are most likely going to go your way. And that's how you technically earn money in this. It is a long-term strategy. It's not something that you become rich, make you rich after one day, because that is not how this works. Anybody that enters this market and thinks that they're going to become millionaires within the first day or two, they're going to lose all their money. So for example, if I invested in gold, I would use, for example, 2% of my equity, roughly $1,200 in this case, or a little bit more than that, $1,400, $2,400 it should be. So roughly to $2,400 I would invest. And of course, if this is gold, I would use a roughly 2 to 5x, in this case 5x. And what this basically does is that it says $2,400 times 5, and therefore your exposure is $12,000 in this case. So by using leverage, you're basically multiplying your equity, and you're actually investing 5 times more than your actual equity. So yes, and there's another thing. If you use too high leverage, or if you use leverage at all, the thing is with leverage is that you technically borrow money, and every single time you borrow money, you have to pay interest, and that's where the fees come from. So down here, you can see that the daily fees for this investment of $2,400, 5x in leverage, so exposure 12,000. you will pay a daily fee of $0.92. So it doesn't sound like a lot, but if you get stuck in a trade and you have to hold this for weeks and probably also for months, that becomes quite a lot of money. Because, for example, the weekly fees as well are $2.76 for this trade. And this is not a massive trade. This is, if you use, for example, $10,000, you would pay a daily fee of $3.83. Weekly, $11.49. So this becomes a lot of money really fast if you intend to hold it for a long period of time. So just keep that in mind. The higher leverage, the bigger the fees. You just see how far they go up. If I use, for example, 100, 10,000, 100 leverage, I would pay a daily fee of $76 and $229 a week. That is fairly insane. Of course, it is easier to earn money this way, but the risk is just enormous, and therefore the fees are also much higher. So yes, that is leverage and risk. And as I just conclude, in stocks, I use 1x. That's it. I don't use any more than that. I use 2% to 5% of my total equity every time I trade. In Forex, I can go up to maximum of 10x, and for indices and for commodities, I use in between 2x and 5x. So I've also added my leverage to the signals in Patreon in order for people to see basically what I'm basically doing. Yes, so let's look at patterns. We'll basically start with that because we have been through Fibonacci retracements and we have also been through some of the support and resistance levels. But we'll look at patterns, and the patterns that we're going to look at are, for example, flag patterns, and we're going to look at triangular patterns. So this is gold, and technically we don't need any indicators for this. It is just a matter of looking at the chart, at the candlesticks, and then spotting where we have flag patterns and when we basically have triangular patterns. So it is, if you go to lower time frames, you will see these patterns all the time. And they are extremely helpful. For example, if you look at the daily chart to determine where is basically the long run in this market, where are we technically going? So we can start out by looking at flag patterns. And the reason why they're called flag patterns is because they look like flags. So I can zoom in on this area here because this was a previous flag pattern. So you have a pole here, and then you have basically a flag this way. And what is the thing with flag patterns is that they can be bullish or they can be bearish. So we're in uptrend at this moment, and therefore you should look at bullish flag patterns. If you're a downtrend, then you can look at bearish flag patterns. So I can show you by drawing the pole here. So it looks something similar to this. So this is the increase. This is basically the pole, and this is the flag. So what happens here is that you have a sudden increase, and then you go sideways, or in more familiar flag patterns that you go a little bit down. So the direction of the flag is not sideways. It is sideways in this case, but it can actually go a little bit down, and then you have an enormous increase to the upside. So what happened after this is that we had this move. So we went all the way from, this was all the way from 17.15 and up to 2074. So an enormous increase. And the people that were looking at this were basically looking at this flag pattern. They were expecting increase to the upside because of this flag pattern. So in the opposite direction, for example, when you have bearish flag patterns, you have, for example, this move here. So we don't have a as clear of a flag pattern as we have here, but we have a very similar situation down here. So where is it? It's out here, yes. So this is very recently. So we have the pole here. You have a little bit of an increase to the upside, is basically the flag. And then you have a very, very sudden fall to the very downside. So this was a fall from a top of 1898 all the way down to 1764. So this is an example of a bearish flag pattern, while this is an example of a bullish flag pattern. So of course, this one is much bigger than that one, but they come in all sizes. It is in the bullish one, you have an increase, then you go sideways or a little bit down, and then you have a sudden increase. And in the bearish one, you have a decrease, move sideways or a little bit up, and then you continue downwards. So you can see these patterns all the time. You have one here that's even smaller, down, trades a little bit up, and then it goes down, and so on. So if you look even further, we have a very good example here of a bullish flag pattern. This one is trending downwards. So you have this massive move from 1268 all the way up to 1555, and then you gradually go down, and the expectation is that you're going to have a trend reversal. But the thing that is basically happening here is that you're making a bigger move to the upside. So you could make the argument that this flag was this entire move. So it basically stopped there. So it started here at 1435 and it ended at 2073. An absolutely enormous move. So if you draw this up, it also looks like a flag. You have the pole here, and then you have the gradual decline, and then you just take up to the upside. Of course, we here had a double bottom of this market, and then you can also make the argument that this was basically the move to the very upside. But as you can see, we can have bullish flag patterns like these, and you can have bearish ones that are basically the opposite. They look like L's on the head and so on. So the other patterns that are also very, very useful to use are the triangular ones. So this is gold. This was back in the beginning of August, where we topped in gold in the beginning of August, and then we had this gradual decline. So we're going to stop right around here. So all of this we're not going to use, and all of this we're basically not going to use. So what happened here is that we had in July, mid-July, a very sudden increase in the value of gold from 1800 all the way up to 2073. And then we completely collapsed all the way down to 1860. And then we again had a major increase, decline, increase, decline, increase. And this is probably one of the best examples I can give you of a triangular pattern. So I can write it up like this. So what I was looking at when I saw this is basically that we had above a resistance line, and underneath we had a support line. And when you add those two together, you get a triangle. So the market was behaving in a triangular pattern. So of course, this got significantly overbought, and therefore it is not a part of this. But when you try to write these off, you try to get as many as the tops as possible. So this one, this one, this one, and this one. So there are four tops here. You can basically get it a little bit further down, and then it becomes better. So we have four tops here. That means that we got rejected at this resistance level 4 times. And when you get rejected 4 times in a resistance line, usually the market tends to go the opposite way. So just a rule of thumb here, if you get rejected more times in the resistance, it most likely will head down. If you get rejected more often in support, it most likely will go up. So this is also an example of that. So this is 1, 2, 3, and 4. And underneath, we have the support one. We have 1, 2, and you can also say 3. But actually, you have 2. So we got rejected twice at the bottom, 4 times at the top. And what happens here is that you go up, you go down, up, down, up, down. And then you, at some point, get all the way into this corner. And then the market has to make a choice. Either you basically break to the upside or you break to the downside. In this case, it broke to the downside. And whether or not, how to determine where we break out, that is the tricky part. But to determine where we are going, that is not the tricky part. That is, in most cases, self-explanatory. For example, in this case, that when you get into this corner, this market has to go somewhere. It has to break the resistance line or it has to break the support line. In this case, it broke the support line. And we fell in only 4 trading sessions from 1954 all the way down to 1848. That is some fairly massive move. And if you were paying attention to this, you could have spotted this when we basically broke the support level, then we head down. So we have an additional, if you've been watching my technical analysis videos for gold, we have a bigger triangle that is going on in the gold market at this point. So we can look at these two tops, and we can also look at these two. So we can see it there. So we have 1, 2, 1, 2. We have not tested this one, but I think that we're going to test the lower one first. So I think that we are going to see a test of this support level more often than the test of this resistance level. And as I said before, the more often you test the lower one, it will go the opposite way. The more often you test the upper one, it will go the opposite way. So what I think is going to happen here is that we're going to roll over, we're going to test this support line, and then we're going to go back up and down into this corner. That is what I am seeing at this point, and that is also what I think is going to happen. And also, because I'm bullish, really bullish on gold in the long run, I think that when we get into this corner, we are going to break above this resistance line. And the reason for that is because economies have to come back to some kind of normal. And in order to do that, governments have to spend money. The central banks have to print more. They will have to increase liquidity in the market and so on. And all of those actions are very bullish for gold because it's basically a safe haven for investors in those kinds of times. So in the long run, I think we are going into this corner and then we're going to break out to the upside. And then we're going to target the 1900 level, the 2000 level, and also 2100. And if we break this previous high here, then of course we will go significantly higher. But we can also look at it from a different perspective, and that is that when we break out of this triangle, we can get rid of this. That means that we are going to go up, and this line here will continue to be supportive. I mean, in the very long run, when we probably look back at this for 1 year from now, we will probably see that we have tested this line several times into the future. So we'll probably go up towards 2000, go back down toward this line, up towards 2100, back to this line, and it will act as support for a very, very long time until it breaks, and then we're going to go down. So these triangular patterns, they can be both bullish and they can also be bearish. So we have an example of no, I don't have an example of a bullish one here, but if I go back to this one, I can write it up. So the reason why we call this a bearish one is because we break to the downside. If we had broken to the upside in this case, then this would have been a bullish one. So that is the difference. That is the only difference between those kinds of patterns. But these are very, very helpful in determining where we actually are going. And as you can see, when we broke below this support line, we have been going constantly lower in this market. And if we went to the other side, then we would have gone constantly higher in this market. So a break above the resistance line, then you have a bullish one. If break below, you have a bearish one. So we can go and look at support and resistance. So we'll go and look at the NASDAQ because I think most people are very interested to see basically what is happening in the NASDAQ right at this point. And most people are getting also very, very nervous of what is going on in the NASDAQ at this point. So we can have resistance lines that are flat. We can have the ones that have a positive slope, and we also can have the ones that have a negative slope. And the same goes for support lines. They can be flat, positive, or negative, and so on. So in this case, we can look at this as a resistance line that has a flat slope. For example, here, this is the top of this indice, and this is as far as this indices has ever gone. So this is the major resistance line. If this breaks, then that is an indication that we are going to go significantly higher in this market. The very lows, if you look at the flat one, is basically down here. So you could argue that it's down here, but I think that this is as far as we will go in this market. If this breaks, then that is an indication that we are going to these very lows prior to the coronavirus, and that is at 9,759. So we could make the argument that we are at the very top, and we are heading to the very bottom at this point. I don't think that is going to be the case. I think that is looking at this as a very, very pessimistic view that we're going to break down all the way down to 11,000 again. That I don't think that is going to happen. These moves of roughly 1,500, 2,000 points to the downside, I think that is something that we are not going to see for a very long time. I could be wrong, but that is just my view at this point, and I'll make my case in a few moments. So if you look at this as a resistance and a support that is basically flat, then this would be the very top, and a break above this would send this significantly higher to 13,000. If we break below this support line, then we are going significantly lower. That basically means that we're going all the way down to this very top here. So if we have a complete economic collapse, then yes, that is possible. Otherwise, no, I don't think that is going to happen. We can also look at this as a positive slope. So if we can get this all the way in, we have the very bottom of this market here and the very top and one here. So when we do the positive slope for the long run, you take the lowest that you basically get, and basically 2 points. So this one, and you basically make a line in between those two. So what this means is that if we get down towards this support line, that is roughly at roughly 11,000, we could basically go to 12,000. So one of the reasons why I made the stop loss at 12,000 is because if we get down here, it's most likely that we're going to break significantly lower. So it is far, far, far away at this point. And as you can see, we are finding resistance in this area. And there is a reason why we're finding resistance in that area. And that's because we're running into the 20 exponential moving average. So if you look at, just put 20 exponential here, you can see that the 20 exponential is just underneath, and we are running into major support every single time we get to this level, and then we're breaking to the upside. At this point, we're at 12,327. The reason for this decline are several, mainly stimulus talks, Brexit negotiations, and also because the US dollar was appreciating. But this is holding firm, and therefore I am not really convinced that we are going to break this and go towards 12,000. But this support line is going to be significant in the future, because if we go further from here, go up and go towards this support line, then this is an indication that you should basically enter this market. If you get rejected here, it means that we are going to go higher. So we got 13,000 here. I think that is going to be the top of this rally. So we're going to rally up towards 13,000, and then we're going to go back down towards around 12,500 or the previous top here, and then we're going to head even higher. We are going to see 2021 as a year where economies are going to go back to work. So there's going to be a lot of spending from both the Federal Reserve and also the government, and that will just push this market even higher. So if you look at this was really bad. If you look at the resistance line, then you could argue that you have a resistance line that is going right here, so quite far away. So the idea with the resistance line is that you get as many tops as possible, and that you basically, when you've done this, you create a channel. So when you've done this, you can see that we're actually at the very lows of this upward trend. We were at the highs here. We broke down quite significantly when we got way over our heads over here. We broke down, rallied up towards this trend line again, broke down towards this lower, up, down, and now we're basically at we're actually at the bottom of this channel. So it's more likely that we are going to go up than we are going to go down when you analyze it in this way. We are finding support here. That is also expected because there's more probability that we're going to the upside than we're going to the downside, as this has been behaving. So when we were here, we were traveling within a really narrow channel between the 20 exponential. As you can see, it was very supportive, and we had the upper trend line here. Every time we got to the top, we sold, buy, sell, and all the way up to when we got to this level, and then we completely collapsed. So a lot of traders got this was basically my worst trade of the year. So I think I entered the market when it was like 12,000, something like that, and then just collapsed. So that's why you have technically stop losses. So this is an example of an upward channel. And downward channels, we can look at the US dollar and the yen, because that has been in a downward channel for a very, very long time. So I have this on TC 2000, and I'm showing every single day now that we are in this channel. So to get it roughly there. So we have been in this channel now for roughly basically since March. So we broke down here, we have been traveling inside this channel. So it doesn't mean that you cannot go outside. For example, this period here, we went outside. But you should expect, if you start breaking down like this, that this was basically just an overreaction and that you were going to enter the channel again. So the same goes for here. We had a massive sell-off, and if you look at the RSI in this area here, it most likely be significantly oversold, while this was significantly overbought. So channels are fantastic to trade because they are very predictable. You go to the upside, you can sell. You go to the downside, you can buy, and then you just go up and down, up and down, up and down. So this is one of the longest running channels I've been trading for a very long time. It's been started back in March all the way here, and it is still ongoing. So we are at the top of the channel, and as you can see, if we get anywhere close to the upper resistance line, I will start selling this because I do expect this to go significantly lower. So the reason, if we start trading this, then I have a stop loss a little bit higher than this because it can go outside like it has done in previous cases, but it's not very likely. So next topic is basically where you basically put stop losses. So we can look at the NASDAQ again. So I've added a few. I thought if I only had Fibonacci and so on, it would be not long enough because we have 20 minutes left at this stage. So when you enter an instrument, you want to buy it or sell it. The way you basically put stop losses is that you basically adjust your risk. It's basically a matter of how much risk are you willing to take. And the risk that I use is basically 2 to 1, 3 to 1, and 5 to 1. And the lower that number is, the more risk you're willing to take. The higher the number is, the less risk you are willing to take. For example, if I wanted to enter a trade around here, and I entered a trade where I said 2 to 1, and basically what that means is that I expect this to increase twice the amount that I think that it's going to decrease. So, for example, if I enter here, I expect it, for example, to increase to that level, and in worst case scenario, I expect it to decrease by half of this level. So, for example, this area here, and that is to the downside. And therefore, I would target this top. I would enter here at 12,397. I would target this top, and I would put a stop loss right underneath here. So this is roughly half of what I expect to earn. Roughly that. And usually I put stop losses underneath the moving averages because moving averages usually are significant support or resistance. So depending on whether or not you're trading in something that is an uptrend or a downtrend, then you focus on where your resistance is or your support is. So this is the 20 exponential moving average. Usually I don't focus on the 20 exponential when I make stop losses. I mainly focus on the 50 because the 50 is more of a guarantee than the 20 exponential moving average is. So we can also use this, I can explain this in a more mathematical term, and that is if I make an investment of 1,000, I can put leverage here at 1, then if I use 2 to 1, then I would expect me to earn 2,000. And my risk would be 500. So in this case. So I'm willing to risk 500 with an investment of 1,000 and a gain of 2,000. So if I have 5 to 1, that means that I would target 5,000 and I would risk, for example, 500. So that is basically what it looks like in mathematical forms. So depending on how high this number is compared to what kind of equity you're basically investing, that's how much you're willing to risk. If you lower this significantly, if I, for example, lower this to only to 100, then my risk is only 1/10 of what this is. So this risk here is significantly lower, but I also run the risk of hitting the stop loss because I'm taking so little risk. So just keep that in mind. And stop losses can also be adjusted. I have adjusted some of the stop losses in the signals, not many of them, and usually I adjust them because it's really irritating that, for example, if you set a stop loss of $100 and it hits $101 and then turns around, then it's really, really irritating. But just a rule of thumb, you should not change your stop losses too often. And that is also a very common mistake that most traders are doing, is that they are trying to increase their stop loss constantly. So, for example, if your first stop loss was 100, then they try to put 50 more, then they 200 more, and then 50 more, and so on. And before you know it, this becomes a massive, massive risk to your entire equity. So don't do that. It is better that you just leave the trade and then start over instead of going from an initial stop loss of, for example, 100 and ending up with a stop loss of 500 or 50 or something like that. More than 5 times more than you were willing to risk. So just keep that in mind. And there's nothing wrong either basically taking profit before you hit take profit. So this is also a very common mistake that traders do, and that is they set a take profit, for example, in the signals. It is only an estimate. It is impossible to know where it is technically going, but it is an estimate based on risk and so on. But to take profit before, that is just fine. And that also means that you are actually earning money. To be really stubborn and to wait for a specific take profit can be very expensive. For example, if you want to take profit, for example, here you invest 1,000 and you get to 4,900 or something like that. And then you say, no, I want those $100 as well. but you have earned 4,900 so far. It is really stupid not to take profit then. So just keep that in mind. It can actually turn around when you're at 4,999 and then head all the way back down. And therefore, it is a good idea to just take profit, get your profit, and so on. But to take profit too early is also a mistake. For example, if you set your stop loss to 500, you invest 1,000, your stop loss is 500, and then you take profit at, for example, at 100. That is not good. For example, now your risk, technically your risk is bigger than your reward, and that is not a very good trade to do. So just keep that in mind. You should not leave the market too early, but it's also a good idea to leave the market before it becomes too late. Yes, it is 15 minutes until the US, we end the session. It's 45 minutes until the US session starts. I don't know if anybody has questions about any stocks or trades and so on that I can look at. I usually don't enter the market on Fridays until the US session opens because everything happens in the US session on Friday. Okay, I can tell you what I've been looking at. So first of all, one thing that you should pay attention to, and that is that the US dollar is appreciating at this point. So that, of course, has a negative effect on the indices, on oil. For example, you can see that oil is down today. Most of the commodities are down today. And the reason for that is because, well, if you want to buy some of these commodities on the world market, then you basically pay for it in dollars. And the more expensive the dollars gets, the more expensive basically these commodities that get, and therefore demand for them, they basically decreases, and therefore prices decrease. So every time this goes up, this goes down. Most of it, not all of it, but most of it. So I haven't been looking at commodities for the last 2 days. We did trade in aluminium that worked really well. We'll most likely be able to enter aluminium again when it gets close to the 50 moving average. You can look at this point when the 20 exponential moving average. So it has started to decrease, which I expected it to do, and we're heading towards the 20 exponential moving average. So if you get down to here and we see that it is supportive again, then it is possible to buy into this. The US dollar is expected to decrease or depreciate, I need to say. So we can see that we have created a little bit of a flag pattern here. So we had a pole trading a little bit upwards, making the inverted flag here, and now we're starting to decrease again. So if we cannot take out these top candlesticks here, then this is almost certainly going to fall significantly lower. So if we take out this lower part here, this is 1939, then we are going much lower. Probably all the way down to 90, which is down here. That is going to be the next support, almost certain of that. So I've mainly been focusing on the indices because I think these are going to be the the ones that are going to earn a lot of money. It is also possible to jump in to invest in the German DAX at this point. It was down nearly 2% earlier, but I need to see what happens. Brexit negotiations, they have been ongoing now for nearly 4 years. They're getting quite irritating, but I think it's both in the UK interest and the European interest to get agreements. But that agreement will most likely not be as good as the one that Britain had before it was in the EU. So that is probably the hurdle that they're in at this point. So there is going to be an agreement because otherwise both of those both Britain's economy and the European Union's economy are going to suffer tremendously if there's not going to be an agreement. So that is going to be positive news, most likely. And there is going to be some kind of stimulus before Christmas or the new year. That is also a guarantee. And now we had the news with the vaccine. So there are three major developments that most likely will go in the favor of an increase in the S&P, Dow Jones, and in the NASDAQ. And therefore, I'm focused on these indices at the moment, mainly. No, I did not. I can basically take it next time. I put it on the list, but I did explain Fibonacci a little bit in the last two sessions, and I can take it the next time. So instead of talking about the same things, I chose to go and discuss leverage and risk, take profit and stop losses, and support and resistant levels, and so on, and then patterns as well. So if you look at we can look at the NASDAQ. I can show you my idea for the NASDAQ. So we need to go in here. Yes. So if you look at the NASDAQ at this point, we can see that we have just done more of the same that we have done previously. So I will be very surprised if we break below the 20 exponential. Of course, can happen if there's no agreement in the EU and Britain, if there is no advancements in the stimulus talks, and if the vaccine, for example, is not a vaccine. But all of those three things are highly unlikely. And therefore, there is going to be a significant amount of good news coming out. So we have tested on 20 exponential twice, got rejected both times. And if we manage to take out this top here, then we're heading to 13,000. That is nearly a guarantee. Even though these technical indicators are looking fairly bearish at this point, I am looking only at the 20 exponential, what basically is happening there. If you look at lower time frames, we could actually be heading towards this level here, and this is where I put my stop loss. It is possible. It's very, very, very unlikely. And the reason why I say it's very unlikely is because the RSI will be in single digits when we get down there. And that is not very plausible. The RSI for the NASDAQ is rarely, very rarely that it's oversold. So it has been trending upwards, and that also means that you have a significantly higher RSI than you have a lower RSI. So at this point, I think that we're going to turn around here, most likely. If we take out the 50 moving average, in the 4-hour chart, then the only obstacle left is basically these highs, and then we're going to go higher. So yes, I think that is the end of this session. I will. I can go through Fibonacci retracements the next time. I have discussed it twice in the last 2 videos, and they are available on Patreon. But I will start focusing on trading after this. That means presenting different kinds of stock, indices, forex exchange, and so on, and introducing different kinds of strategies of where to invest and how to invest in different time frames. So good luck and good weekend.